8% in one session. Silver didn't just fall, it collapsed. From $94 to $87 in hours. But that's not what caught my attention. What caught my attention is how it fell. Not gradual selling, not profit taking, forced liquidation, margin calls, leveraged positions getting unwound. And while everyone's focused on the price drop, I keep asking myself one question. If this was forced selling, not fundamental selling, if positions were liquidated because of margin pressure, not because demand disappeared, doesn't that create the exact setup for violent reversals? My theory is this. We just witnessed a classic forced unwind. And forced unwinds don't mark the beginning of bear markets. They mark the end of corrections. Let me show you the pattern, because we've seen this before. 2013, 2020, multiple times. And every time, the people who understood what forced liquidation meant bought the panic. The people who didn't sold into it and regretted it weeks later. I'm not a financial advisor. This isn't financial advice. This is pattern analysis based on liquidation mechanics, margin call dynamics, and historical precedent from prior forced unwind events in commodity markets. And what I'm seeing suggests this week will determine whether silver is heading to $72 or preparing for a rally to $110. And understanding the 5 signals that reveal which path we're on is the only edge that matters right now. Let me give you the framework first. Because forced unwinds follow a specific pattern, 4 stages. Stage 1 is extended leverage buildup. Markets rally, investors get confident, leverage increases, margin debt grows. Everyone's positioned the same way, long and leveraged. This creates fragility, not visible on charts, but present in positioning data. Stage 1 is stability masking fragility. Stage 2 is catalyst trigger. Something changes. Could be interest rates, could be dollar strength, could be unexpected geopolitical development. The specific trigger doesn't matter. What matters is it creates enough price movement to trigger margin calls on leveraged positions. When futures fall 3 to 5%, margin calls go out. Traders must either add capital or close positions. Stage 2 is when the cascade begins. Stage 3 is forced liquidation cascade. Margin calls force position closures. Forced selling drives prices lower. Lower prices trigger more margin calls. More margin calls force more selling. It's a feedback loop. And it doesn't stop until either A, prices fall far enough that leveraged positions are fully liquidated, or B, new buyers step in at prices attractive enough to absorb the selling. Stage 3 is maximum pain. This is where weak hands capitulate. This is where 8% single session drops happen. Stage 4 is exhaustion and reversal. Once the forced selling is complete, once leveraged positions are cleared, the selling pressure evaporates. And if fundamentals are still intact, if underlying demand hasn't disappeared, buyers return, often aggressively, because they recognize forced selling created bargain prices. Stage 4 is when reversals happen, sharp, violent, and profitable for those who bought Stage 3 lows. We just completed Stage 3. We're entering Stage 4 this week, and the signals over next few days will tell us if the forced unwind is complete or if there's another leg down coming. Now let me show you what triggered this unwind. 2 macro factors. First, dollar strength. The US dollar index has been strengthening. When the dollar rises, it creates pressure on dollar-denominated commodities. Not because fundamentals changed, but because the math changed. If you're a global investor holding euros or yen and the dollar strengthens, your purchasing power for dollar-priced assets decreases. So you either need to allocate more local currency to maintain positions, or you reduce positions. That creates selling pressure mechanically. Second, interest rate expectations. If markets believe the Federal Reserve can't cut rates as aggressively as previously expected, that changes opportunity cost calculations. Higher rates make yield-bearing assets like bonds more attractive relative to non-yielding assets like precious metals. Again, not a fundamental change in silver supply or demand, but a change in relative attractiveness that creates capital flows. These two factors, dollar strength and rate expectations, created enough price pressure to trigger margin calls on leveraged silver positions. And once those margin calls went out, the cascade began. Forced selling. More margin calls, more selling. The 8% drop in one session is the signature of forced liquidation, not fundamental repricing. Now let me show you the 5 market signals that reveal what's actually happening beneath the surface. These are the signals most retail investors don't watch, but institutional traders do, and understanding them tells you if this is a bear market beginning or a correction ending. Signal 1. Open interest behavior. Open interest measures the number of outstanding futures contracts. When prices fall and open interest falls simultaneously, that's forced liquidation. Positions are being closed, not rolled. When prices fall but open interest stays flat or rises, that's new short selling. Very different implications. If this week shows declining open interest alongside the price drop, that confirms forced unwind. The selling is position closure, not new bearish bets. And position closure selling is finite. It ends when positions are cleared. Signal 2. Commitment of traders positioning. This weekly report shows how different trader categories are positioned. If large speculators reduced long positions significantly, that's forced liquidation of speculative length. If commercial hedgers didn't increase short positions, that suggests they're not betting on lower prices. They're just watching speculators get liquidated. The combination of speculative long reduction without commercial short increase is classic forced unwind signature. Signal 3. Physical market premiums. If physical silver premiums over spot prices stay elevated or increase during the paper price drop, that's telling you physical demand is intact. The drop is paper market mechanics, not real supply demand. Dealers would lower premiums if actual demand was falling. If premiums hold or rise, it confirms the drop is technical, not fundamental. Signal 4. Correlation breakdown. Normally, silver correlates with copper, with industrial commodities. If copper is stable or rising while silver crashes, that's leverage unwind in silver specifically, not broad commodity weakness. If all industrial metals are falling together, that's different. That's macro demand concern. Isolating silver's behavior relative to correlated assets reveals if this is silver-specific technical selling or broad fundamental concern. Signal 5. Volatility patterns. Forced unwinds create specific volatility signatures, large intraday ranges, opening gaps followed by reversal attempts, heavy volume on down days. These patterns are different from bear market distributions, where volume is steady and declines are methodical. Forced selling is chaotic. It creates maximum volatility, and that volatility ends abruptly once the liquidation completes. These 5 signals, updated daily this week, will tell us if the forced unwind is complete or ongoing, and that determines positioning. Now let me show you historical precedent, because forced unwinds in silver aren't new. Example 1. April 2013. Silver crashed from $32 to $22 in weeks, roughly 30% decline. The move was brutal. Leveraged longs were destroyed. But what triggered it? Cyprus banking crisis created temporary risk off. Margin calls went out globally. Silver, being highly leveraged, got hit hardest. Within months, silver recovered to $25. Not all the way back, but significant bounce from the $22 low. The forced unwind created the low. Buyers who recognized that pattern profited. Example 2. March 2020. COVID panic. Silver crashed from $18 to $12 in days. 33% drop, forced liquidation as everything sold, margin calls across all asset classes. But within 4 months, silver was at $29, 141% rally from the forced liquidation low. The people who bought at $12 to $14, recognizing the forced selling, made extraordinary returns. The people who sold into the panic locked in losses. The pattern is consistent. Forced unwinds create maximum pain, maximum capitulation, and maximum opportunity. Not immediately, but within weeks to months. Now let me show you the critical technical levels, because this week, price behavior at specific levels will determine the path forward. First level, $78. This represents a key support zone from prior consolidation periods. If silver holds above $78, the forced unwind likely found its low. Buyers are stepping in, the liquidation is complete, and a base is forming for reversal. But if silver breaks below $78 with conviction, that suggests either A. The forced unwind isn't complete, more leveraged positions remain to be liquidated, or B. Fundamental demand is actually weakening. This isn't just technical. Second level, $72. If $78 fails, $72 is the next major support. This level represents deeper retracement to long-term trend support. Breaking below $72 would suggest this isn't just a forced unwind. It would indicate structural weakness. That's where the bullish thesis gets seriously challenged. But holding above $78, or bouncing strongly from $78 on a test, confirms the forced unwind pattern. Here's how to watch these levels. If silver tests $78 this week and bounces with strong volume, that's classic exhaustion low. Forced selling found buyers, reversal likely. If silver breaks $78 but recovers back above within a day or two, that's a false breakdown, still bullish. But if silver breaks $78 and continues lower towards $72 over multiple sessions, that's different. That suggests more selling to come. The behavior at these levels, combined with the 5 signals I mentioned, creates a complete picture of what's happening structurally. Now let me show you what could destroy the bullish scenario, because balanced analysis requires acknowledging what could go wrong. First destroyer. Dollar continues strengthening aggressively. If DXY breaks above 110 and holds, that creates sustained headwind for all commodities. Even with intact fundamentals, strong dollar pressure can keep prices suppressed for extended periods. The bullish case needs dollar stabilization or weakness. Continued dollar strength is the primary risk. Second destroyer. Interest rates spike higher unexpectedly. If 10-year yields go from current levels to 5.5% or 6%, that changes all asset allocation models. Higher yields make bonds extremely attractive relative to zero-yielding metals. Capital rotates away. Even long-term holders might reduce positions to capture yield elsewhere. The bullish case needs rates to stabilize or decline. Sharp rate increases would be problematic. Third destroyer. Industrial demand collapse. If recession hits and industrial production falls, silver demand from solar, electronics, automotive, all weakens. Supply deficit shrinks or turns to surplus. That undermines the fundamental thesis. The bullish case is built on structural deficits. Demand collapse changes that. Fourth destroyer. Forced unwind isn't complete. If this week shows more margin calls, more liquidation, more selling pressure, it means leverage hasn't been fully cleared. Another leg down becomes likely. The bullish case needs the forced selling to end this week. If it continues, $72 or lower becomes probable. These 4 scenarios would invalidate the forced unwind creating buying opportunity thesis. And honest analysis requires acknowledging them. The question is, which scenario is more probable based on current data? Now let me show you why this week is critical. Because markets often resolve uncertainty quickly after forced liquidations. They don't drift, they move. This week, several catalysts converge. Commitment of Traders report releases Friday. That shows positioning changes. If it confirms large speculative long reduction, the forced unwind thesis is validated. Economic data releases throughout the week. If data comes in strong, supporting higher rates and stronger dollar, that's bearish. If data disappoints, suggesting rate cuts stay on table and dollar weakens, that's bullish. Geopolitical developments continue evolving. If tensions ease, safe haven premiums fade. If they escalate, premiums return. And technical level tests. Silver will either hold $78, bounce, and establish reversal, or break $78 and test $72. That decision likely happens this week, not next month. So by Friday close, we'll know significantly more about whether this was forced unwind bottom or beginning of deeper correction. The data, the positioning reports, the price behavior at key levels all converge this week. Here's the decision framework for different scenarios. Scenario A. Silver holds above $78. Commitment of traders shows large speculative reduction. Physical premiums stay elevated. Dollar stabilizes. This is the forced unwind complete scenario. Buyers step in. Reversal begins. Potential for move back to $95 to $100 over weeks. Positioning. Accumulate on any weakness near $78-82. Scenario B. Silver breaks $78 but holds $72. Signals are mixed. Some suggest unwind complete. Others suggest more pain. This is the uncertainty scenario. Range bound $72-85 for weeks. Volatility but no clear direction. Positioning. Stay neutral. Wait for clarity. Don't chase either direction. Scenario C. Silver breaks $78 and $72. Commitment shows continued leverage. Physical premiums normalize. Industrial demand data weakens. This is the bear case. Deeper correction to $65 to $68 possible. Positioning. Reduce exposure. Wait for true capitulation before re-entering. Scenario D. Silver bounces sharply from current levels. Doesn't even test $78 again. Closes weak above $92. This is the V-shaped reversal. Forced selling exhausted immediately. Short squeeze possible. Positioning. If you're not in, you missed it. If you are in, hold. Which scenario unfolds? The data this week tells us. But being prepared for all scenarios and having planned for each is how you navigate uncertainty. Now let me show you the risk management framework. If you held through the 8% drop, you faced emotional pain, down significantly in one day. The question now, do you add, hold, or exit? The framework. Ask why you owned silver originally. If fundamental thesis, supply deficit, industrial demand, monetary hedge, did fundamentals change? No. Then hold or add on weakness. If technical thesis, momentum, breakout, that broke, consider exiting and re-entering on new setup. If you didn't own silver and want exposure, this week is critical. Don't chase rallies. Wait for either A. Clear bounce from $78 with volume, confirming support, or B. Breakdown to $72, full capitulation, then reversal. Either pattern gives clear entry. Buying in middle of uncertainty is speculation. Position sizing. If volatility of 8% in one day is acceptable, your size is correct. If it created distress, reduce. The correct size is the one you can hold through forced liquidation events without panic. Here's what I'm watching hour by hour this week. Monday, Tuesday. Does silver hold above $85? If yes, forced selling may be exhausted. If breaks toward $80, more liquidation likely. Wednesday, Thursday. Economic data releases. Does data support stronger dollar, higher rates, bearish metals, or weaker dollar, lower rates, bullish metals? Friday, commitment of traders report. Does it show large speculative long reduction confirming forced unwind? Weekend, synthesis. Do all signals point same direction, or are they conflicting? By Sunday, the picture will be much clearer than it is today. Now let me address the contrarian opportunity thesis. Forced unwinds create some of the best risk-reward setups in markets. Why? Because selling is mechanical, not fundamental. Margin calls don't care about value. They force liquidation at any price. That creates bargains for those with capital and conviction. The people who bought gold at $1,450 in March 2020 during forced liquidation made 3.5x as gold went to $5,200 plus. The people who sold into that panic locked in losses. Silver at $87 after 8% forced liquidation drop. If fundamentals are intact, if industrial demand persists, if supply deficits continue, that's potential opportunity. Not guaranteed. But the risk-reward is skewed favorably. Downside to $72 is $15. Upside back to $110 is $23. That's 1.5 to 1 reward risk just on mean reversion before considering any fundamental improvement. The contrarian framework. When everyone's panicking, when forced selling is happening, when capitulation is visible, that's when opportunities emerge. Not comfortable, not easy, but historically profitable for those who execute. Here's the final thought on forced unwinds. They're painful. They shake conviction. They create doubt. Maybe I was wrong. Maybe the thesis is broken. But forced unwinding is mechanical, not fundamental. It's leverage clearing, not demand disappearing. And understanding that difference is what separates those who buy bottoms from those who sell them. This week determines which group you're in. If you panic sell into continued weakness, you're selling to the buyers who recognize forced liquidation opportunities. If you hold or add strategically at key levels, you're potentially positioned for the reversal that follows forced selling exhaustion. The pattern is clear. Forced unwinds end. They don't last forever. Leverage can only be cleared once, and once it's cleared, if fundamentals are intact, prices recover. The question is whether this week's signals confirm the liquidation is complete or warn that more is coming. So here's my question. Are you going to let forced liquidation shake you out right before the reversal? Or are you going to recognize the pattern, understand the mechanics, and position accordingly? Because if this is a classic forced unwind, and the 5 signals this week confirm it, the people who bought $78 to $87 will look back and realize this was the opportunity. And the people who sold will realize they capitulated at exactly the wrong time. The choice is yours. But understand what you're choosing between. Mechanical selling creating temporary prices disconnected from fundamentals. Or structural breakdown requiring deeper corrections. The signals this week reveal which reality we're in. Watch them closely. They're telling you everything you need to know. If you want these 5 signals tracked in real time this week, subscribe. Because commitment of traders, open interest, physical premiums, correlation patterns, and volatility signatures update daily. And knowing which signals are confirming forced unwind completion versus which are warning of more pain, that's the edge. This week is the decision week. The pattern will reveal itself. The question is whether you see it. And if you see it, whether you act on it while others panic. That's how bottoms get bought. Not by predicting them, by recognizing them when they arrive.